If you own your own corporation in Canada, the decision around how to pay yourself through that corporation is an important one. It can be worth thousands of dollars a year. And if you compound that over multiple years, those numbers can get pretty large. Most business owners haven't actually run the math since they originally incorporated, and today we're going to change that. My name is Evan Jones and I'm a chartered professional accountant. I'm also a chartered investment manager and I work as a wealth advisor to Canadian business owners. My focus is on integrated wealth planning, not tax preparation. By the end of this video today, you're going to understand the 4 variables that really change the determination as to whether you should lean salary versus dividends, and you're also going to understand 3 scenarios where that traditional math changes. Quick housekeeping. Everything that I say here today is general purpose information. Your situation is likely different, so if you have questions about your individual situation, you should be consulting your CPA or your advisor. The Canadian tax system is built on a theory of integration. And at its core, or the foundation of integration, is really trying to keep fairness within the tax system. So the CRA really wants to ensure that if you're earning income and you've got a corporate layer, you're in no better position if you earn that income inside the corporation and it flows out to you personally, or if you were a sole proprietor and you didn't have that corporate layer and it just earned income to you personally. In theory, integration is great. In practice, it is imperfect. And those gaps, sometimes small, can add up to meaningful differences. And the one takeaway here is you're not optimizing one tax bill, you're optimizing 2. So when we have one desired outcome or a similar outcome where we're looking at household after-tax dollars, there's 2 scenarios that we can use to get there. Number 1 is we have corporate earned income at the top here. You can pay yourself a salary deducted by the corporation. And then there's personal income tax and CPP contributions on that, and you end up with your after-tax household income. The secondary path is dividend path. So we don't pay a salary and you pay corporate tax on all the retained earnings. Then you pay yourself a non-eligible dividend, or it's declared. You pay personal tax on those dividends, and then you have the after-tax household income. So now let's look at those numbers in practice. An important aspect to understand is that we are trying to maximize the combined household result over your entire working career. This includes corporate tax, personal tax, RSP room, CPP contribution room, retirement, and your eventual exit from the business. That's a larger framework than most business owners think about when they're setting up their pay structure originally. Now let's take a look at the variables that can move the needle in terms of the decision making behind salary versus dividends. That first variable is RSP room. Salary is what the tax system calls earned income. Now, earned income is what also earns you RSP contribution room. An RSP contribution room is earned at 18% of the previous year's earned income. Dividends are not classified as earned income, so if you were paying yourself only dividends out of your company, you're not actually earning any RSP contribution room, and you're giving up a very significant tax shelter over the long term. Variable number 2 is CPP contribution. Now, as the owner of the business, you're going to pay both sides of CPP. So you're going to pay the company or employer sponsored and the individual. So that's a pretty significant cost when you add it up. So this would be one of the ones that's probably a little bit more contested, or there's arguments on both sides for it. But in my opinion, when you're getting down to the retirement planning aspect, having CPP, which is a forced annuity that's paced with inflation, is very valuable in retirement. You have to fund less of your income through your savings if you have that annuity structure in place. Variable number 3 is cash flow. So depending on the business needs and the personal needs can change the answer. So a salary is a deductible expense to the corporation. So the income that's earned inside the corporation less the salary is what you pay corporate tax on. If there's no salary being distributed to the shareholder, it's all of the corporate earnings you're paying corporate tax on, higher amount of corporate tax, but you're not paying a personal tax expense at this point unless you pay yourself out a dividend at that point. Paying dividends allow corporate profits to remain inside the company until dividends are declared. So again, depending on company cash flow needs and personal cash flow needs, it can change that answer. Variable number 4 is household and corporate or organizational structure. So the situation can change and it can get more complex the more variables are at play. So depending on if your kids are in the business, if your spouse is in the business, TOSI rules can come up, which is tax on split income, which is a little bit past the detail that we're going to get into in today's video. But whether or not you have a family trust, a holdco, all those things can really come into play and again, change that answer. So we're going to bring this home with an illustrative example so that you can actually see the numbers behind the calculations. So we'll take this individual, we'll call her Sarah. She owns 100% of her company, the CCPC, and this company earns $300,000 of active business income a year. Sarah individually needs $120,000 of personal income coming in to run her household. So we're going to look at three options. One is all salary, one is all dividends, and the third is a combination or a blend between both of them. So if we actually run those numbers through, let's look at the Saskatchewan side. What you can see is a $300,000 pure salary is path A, but you can see we've got it at $295,000. That's assuming that the company has paid the employer portion of the CPP. So $295,000 is kicked out as salary personally to Sarah, and we can see $110,000 of personal tax on that income, less $4,646 in CPP contributions, and her net household personally after tax, she's left with $180,421. If we compare that with path B, which is going to be all dividends, what we can see is that there's no CPP contribution off the top. So $300,000 of active business income comes in. In Saskatchewan, there's approximately a 10% small business deduction, going up to 11%, but that's going to be $30,000 of tax corporately, left with $270,000 of cash inside the corporation. So we can pay that full amount out in the form of a dividend, and she's going to end up paying $77,000 of personal tax on that, but she is left with $192,890. So if you notice, there's a pretty substantial difference between those two numbers in the net result personally. All salary is $180,000 net, all dividend is $192,000. So that's where some efficiency on the all dividend comes into play. And again, integration is not always perfect. The third option is that we can do a blend. So we can do a portion of her salary up to the YMPE, which is about $85,000, and then we can pay the rest out in dividends. So path, $85,000 of salary, personal tax, CPP contribution nets out $57,000. RSP room created is $15,000. We're left with $210,000 of corporate earnings. Tax on those corporate earnings, we're left with $189,000. But we have to pay out that dividend to make up the remainder. And so if you pay out that $180,000 fully, there's another $63,000 of tax, and Sarah is left with $182,000. So you can see it's not quite as tax efficient as the all dividends, but it is more tax efficient than the all salary, okay? But a third option here on the blend means we don't necessarily have to pay out all that additional money in the form of a dividend. We can leave some money in the corporation, being that Sarah only needed $120,000 of after-tax personal income. And this will change depending on your individual situation. And this is where it gets important to actually run these numbers. So if we look at the blend, we can say, we know what the YMPE is, so we're gonna pay a salary up to $85,000. We know how much Sarah needs personally, so we're gonna pay up salary up to 85, and then the additional up to 120 is going to be filled or backfilled by dividends, and we know the active business income is 300,000. So just like the blend, 85,000 of salary, 20,000, 23,000 approximately in personal tax, and $4,600 in CPP contributions, nets $57,000 for Sarah. Now we know we need an additional 62,000 to make up the 120. So we have to pay a grossed up amount of dividends out and pay personal tax on those dividends, okay? But that makes up the $120,000 of net after-tax household income. Now, if we look at the corporate side, we've got a deduction for $85,000 plus the CPP contribution. So we're left with $210,000 of corporate earnings. At the small business rate of 10% approximately, that's an additional $21,000 of corporate tax. Left with $189,000, less the dividends. Well, now we've got $100,000 of corporate after-tax retained earnings that she has the ability to defer. Now, that $100,000 can be used to reinvest back into the business. It can be used to buy property or marketable securities, Okay, so in this environment, we've got a few things that have been completed. Number one is she's created RSP room. She's also created CPP contributions and building in that forced annuity savings. She's also deferred about $100,000 of income that she's not paying personal tax on, which gives her a higher amount of starting dollar value to invest going forward. So the blend at the end of the day is usually the advisable situation. Taking out enough for your lifestyle expenditures to be met, deferring the rest inside the corporation, and reinvesting inside the corporation. So as I mentioned, the blend works for most owners most of the time. But there are scenarios where that decision criteria can flip or change depending on your situation. And situation one is when you're approaching retirement with little to no RSP room. So you likely have decades of working experience, you've done the blend for multiple years, you've contributed to CPP, you've built up your RSP earnings, and you don't have that long of a runway before you finish work. In this scenario, there's not a lot of benefit to continuing to pay yourself a salary to build up that CPP or that additional RSP room. Situation number two is if you have family members that are involved in the business. So splitting income between family members was changed in terms of the addition of the TOSI rule, so they made it harder to pay out to family members. But if you have active members that are actively engaged in the business and they're in lower tax brackets, there's a value to paying them a reasonable salary. And so that changes the kind of framework to paying out more salary versus all dividends. Situation number three is your eventual exit or the selling of your small business shares. There are certain tax benefits to selling qualified small business shares, and that is the capital gains exemption. I won't get into the details of that, but the reality is that you have to have your shares being qualified, and that qualifying factor is very important. And one of the qualifying factors is that company has to be purified at time of sale. So 90% of the assets of those shares have to be used in active business. So if you have too much cash, marketable securities, cash value life insurance policies, it can put you offside. So as you get closer to selling those shares, you want to basically purify that company. So you likely want to pay out of the company and not defer those dollars, whether it's an intercorporate dividend up to the holdco, paying out personal dividends. Final takeaways: integration is the concept of fairness. While it's nice in theory, sometimes imperfect in practice. You should always be looking to optimize your economic value over your lifetime or your entire working career, not just a singular year. You need to consider all variables when making these decisions, such as your RSP contribution room, CPP contributions, cash flow, household and organizational structure, and your eventual exit. One important consideration is also not to use US focused information. There's a lot of videos out there that are centered around the US framework, which is completely different than the Canadian tax system. Most business owners have kept the same situation or kept the original structure that they set up originally, whether that's 5, 10, 15, 20 years ago. That may be correct and it may not be, but at the end of the day, you should understand why you settled on the numbers and the framework that you did. To help you run the math, you can access the Excel spreadsheet that I put together. The link is in the description below. And if you're an incorporated business owner in Canada and you want to dive deeper into this and work with me, my contact information is also below.